We are in the early rounds of an inflation fight that should have started months ago. The big guy, reigning champion, powerful Powell, has entered the ring with his head held high, but commentators say he lacks the training necessary to beat his next opponent. Printing and handing out money was easy. He took down COVID with a left and then a right. Well, a click and a click. But now he's in the fight of his life. After the first few rounds, inflation is clearly dominating powerful Powell and looking strong doing it. Resting on his stool, Fed Chairman Powell looked down at his trainer and said, "No one expects that bringing about a soft landing will be straightforward in the current context. Very little is straightforward in the current context. The Fed faces a challenging task. The bell rang for round 3. Ding, 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 ding. Fight, his trainer yelled, fight. As powerful Powell stood up and stepped toward his opponent, his trainer hung his head and sighed. Sitting ringside, the legendary hedge fund manager Stanley Druckenmiller explained that earnings don't move the overall market. It's liquidity that moves markets. Druckenmiller said the Fed's easy money is lulling investors into a false sense of security. Investors are continuing to ignore risks. And here we are. The Wall Street Journal reported this: a hot economy and rising inflation at the same time. The Fed has never successfully fixed a problem like this. The Fed says it is possible, but many factors are out of its control. John Taylor, economics professor at Stanford, said the Fed is strikingly behind. A soft landing would mean this: the CPI is currently at 8.5%. David McIlvaney says that inflation is at least 13%. And John Williams of Shadow Stats says it is 16%. Chairman Powell says that he wants to bring this down to 2% and not cause unemployment to rise. Really? Really? During the past 80 years, this goes back to World War II, the Fed has never lowered inflation as much as it is setting out to do now without causing a recession. And in the past 50 years, there have been about 7 recessions. I'm Ben Reppond. Today is April 26, 2022. I'm coming to you from Tampa, where I'm attending the annual conference for the National Association of Active Investment Managers. I want to give you a context for my broadcast. I'm an independent investment advisor, and I do completely independent research. I operate under a Series 65 fiduciary license. My firm, Reppond Investments Inc., is an independent, registered investment advisory firm. I am beholden to no one except my clients. My goals in my broadcasts are to remove any bias that I may have about the future direction of the market, to stay true to my goal of independent research, present material to you that you're not likely to get elsewhere, and present it so that it is helpful to the average investor. Links to outside resources are in the comment section below. I do not allow any ads, but it is helpful if you would like this video, share it, and subscribe to my channel. In today's video, I will discuss supply chain issues, various aspects of them, where I believe they have begun and how they are likely to impact us. Inflation and coming interest rate hikes, the risk of a coming recession, the current direction of the stock market, and a segment on gold and silver. In my research, I became convinced that the supply chain issues, they're everywhere, and there isn't just one cause. There are many causes of supply chain issues. There's breakdown everywhere, but I came back to China because I believe a lot of it starts there, and then it reverberates and continues throughout the world, and certainly the United States. And the largest port in the world, shipping port, is Shanghai. And there are many ports in China. There are 5 major ports, the largest of which is Shanghai. Back to 3 weeks ago, early April, China went into a serious lockdown. According to Business Insider, there are 400 million people barricaded from the outside, locked in their homes and apartments. 400 million locked in from the outside in either a partial or complete lockdown. These people work some of them work for these ports. And I believe the issues that are in the Chinese ports, and particularly in the port of Shanghai, is symptomatic of the fact that a number of the people who are locked in their apartments and homes are unable to get to work. I want to show you a clip from CNN, and it's done by interview by Aaron Burnett, and they do a good job with explaining what is going on right now in Shanghai. And then I'll take it after that, and you will see the next steps as we go into the US and other parts of the world.
Shanghai shut down. Tonight, there's growing outrage over the Chinese government's increasingly harsh COVID restrictions in the biggest city in China. People are struggling to get access to food, screaming on the streets in frustration. There was a dog beaten to death by a COVID prevention worker after finding out its owner was infected. And it comes as Shanghai, despite this unbelievable shutdown, saw more than 26,000 new infections on Sunday, which is a record. David Culver is out front. And I want you to know he is part of the only American TV crew living through Shanghai's lockdown.
You'd never expect to see people in Shanghai, China's most affluent and cosmopolitan city, screaming for food. We are starving, they yell. But after weeks-long COVID lockdown with no promised end, desperation. One community volunteer recording the home of an elderly woman. She says neighbors heard the 90-year-old shouting help for 3 days, pleading for food. Her fridge, empty. Volunteers were finally able to get her a meal. China's central government now in charge of managing Shanghai's COVID outbreak. In a month's time, the daily case count went from double digits to more than 26,000. A Shanghai city leader choked up at a news conference over the weekend, apologizing to Shanghai's more than 25 million residents for failing to meet expectations and promising improvements. Those of us living here kept to our homes. CNN, the only U.S. TV network with a team living through the lockdown. In my community, we're only allowed out when summoned by workers using a megaphone, and when dark out, a flashlight. Getting a late evening now request to go get a COVID test. My neighbors and I line up, ready for health workers to scan our QR codes, which link the results to our ID. Night or day, the testing is constant. Someone in the community tested positive, so they'll test now each of us once again. We can also leave the house to line up for government distributions or to get approved deliveries, usually the most exciting part of the day. What looks to be vacuum sealed pork, and then several boxes of traditional Chinese medicine. A bunch more face masks, a box that has a bunch of fresh fruit. On top, they have some frozen meat, and then 2 antigen kits. Food deliveries this plentiful are rare, so most of us spend our mornings trying to order groceries online, but orders sell out quickly. Not enough delivery drivers to get through the lockdown barriers. Communities like mine resorting to group buys. We come together in chat groups and try to source food directly from suppliers in bulk. Neighbors helping neighbors is a common theme across the city. We found a safe drop spot to trade cheese for oranges. Our community's volunteers help us source food where they can, though they too are exhausted and hungry. From above, you see this metropolis, quiet, eerily empty. But on the ground, there are tragedies shared daily online. This man recording his father, who says he's unable to get admitted to a hospital in the strained system. His dad later died, he says. In this video, a neighbor capturing the wailing of a heartbroken woman, crying out that her loved one had died because of the lockdown. And this video sparked outrage on Chinese social media. It shows a worker in a hazmat suit brutally killing a pet corgi because local officials worried that it might have carried the virus. The owner was in government quarantine. All of this is a result of China's zero COVID policy, a directive from the top. President Xi Jinping on Friday praising China's zero COVID approach. State media echoing a glowing narrative, showing an orderly mobilization in Shanghai with an abundant food supply and rapid construction of more than 100 makeshift hospitals with capacity to treat more than 160,000 people infected. But patients taken to those government quarantine centers sharing a very different reality online, posting videos of unsanitary conditions and people using isolation facilities still under construction. Some seen frantically running at distribution sites, scrambling for food and blankets. The uncertainty leaving this man broken, doing the unthinkable, questioning the leadership aloud, asking, where is the Communist Party? And Aaron, as we look at this latest surge, it's worth noting that China has only approved its own Chinese-made vaccines for use here. The country's National Health Commission says nearly 90% of folks have been fully vaccinated, but among those 80 years old and older, talking about the most vulnerable, that number drops to about half. Chinese health authorities, though, they claim vaccines here are effective in reducing illness severity and deaths, though some are skeptical of the official numbers. And Aaron, then there's this. There's growing concern, once again, this reminds me of Wuhan, that China is once again underreporting COVID deaths.
Well, and that's, I guess, that's the crucial question. You mentioned Wuhan, David. I mean, your report, by the way, is just phenomenal. And thank you, because I know that the sort of mental duress you are under, along with everyone you're with. But you were in Wuhan when the COVID outbreak first began. I remember seeing you there. You put on the hazmat suit. You witnessed it. You witnessed that total shutdown. But you're saying it pales in comparison to what you're living through now?
Yeah, I didn't think we'd ever go back to that type of lockdown. I mean, the scale alone of this one goes well beyond Wuhan in 2020. Shanghai's population is more than twice the size of Wuhan. It's about 3 times the size of New York City's population. And most shocking is that this is happening here in what is the country's cosmopolitan, most affluent financial hub. I also think, Aaron, that the attitude has shifted more than 2 years since that initial outbreak. You know, folks early on, they were so terrified of contracting the virus. Now it seems there's greater fear for China's extreme isolation and quarantine measures. And so you have fatigue, frustration, desperation, Aaron, all of that setting in.
All right, David Culver, thank you very much.
Outside the 5 ports in China are ships. These are large container cargo ships. What you see from a satellite view is there are 477 of them awaiting entrance into the harbor and to unload their cargo. This gives you a sense for the magnitude of the shipping that goes in and out of China, particularly out of China. Like in the U.S., China moves once goods arrive in the port or they're shipped to the port by freight, their truckers are needed to distribute the food or bring the food and other items from throughout China to those ports. So the port is sort of the hub and that items come to and from. And the truckers are reluctant to go into the cities right now because they are as soon as they get in, they're being swabbed. And if they test positive for COVID, they risk being quarantined and part of the lockdown. So they don't want to participate in that. So they're staying, not 100%, but many of them are staying out of the cities, and which is creating a further backlog and breakdown in the supply chain. Next, I want to show you, kind of move over to the US and show you what's happening in the ports. These are just the ports of Long Beach and Los Angeles, but there are other ports on the West Coast and, of course, the East Coast as well. But this just gives you a sense for what is happening when you get to the other side of the Pacific.
With a record number of containers piled high at the ports of LA and Long Beach, idle cranes may be a surprising sight.
There's no room in the yard to offload a vessel.
Local longshoreman union president Ramon Ponce de Leon took us dockside to explain why it now takes so much longer to unload these ships.
It's normally cooking around here. Everybody's moving, but because there is no space in the yard, there's not that much we can offload.
So that's why we're not seeing a lot more cranes moving around.
That's correct.
Increased consumer spending during the pandemic led to even more imports clogging up the ports. Do you guys take pride in the amount of containers you can move?
Oh, definitely. It's like a game. It's a challenge. It's fun, you know.
Crane operator Rick McCrae used to work a lot faster. How long would it take you in general to unload a ship like this?
Probably 3.5, 4 days.
How long is it taking now?
It's taking about 9, sometimes longer.
He can only unload a container when there's a place to put it. 20 million of these.
20 million.
Gonna come through these ports.
Come through the ports.
Ponce de Leon showed us row after row piled high. You may think these trucks line up for the first load available, but that is not the case. They are here for specific containers, and sometimes they're in the middle of the pile. It's like a giant game of Jenga. Move 4 containers just to get to 1 on the bottom. How long are these containers waiting here on average now, do you know?
The dwell time here is over 9 days.
Add that to the time it now takes to offload, and it could be 18 days before these containers even leave the dock.
There is a lack of food production around the world, resulting in escalating prices and availability. This comes about from the war in Ukraine, because there's a lot of food production that goes in Ukraine and in Russia. The other thing that's significant is that 40% of the world's fertilizer is produced in Russia and Belarus. So the U.S. is not getting, I won't say any, but it is getting a greatly reduced amount of fertilizer. And this means that the crops in the U.S. they're unable to grow the crops, or they're grown in a more limited capacity. The farmers in the Ukraine missed their planting season because of the war. So a lot of the food that is shipped out of Ukraine, particularly to the rest of Europe, is diminished greatly. It is said that the Ukraine is the breadbasket of Europe. And if it affects Europe, it affects everywhere else. And so we're looking at not only higher prices because of this, limited supply, and I think we're going to see, actually, in developed countries, starvation. I want to show you a clip from CNBC that will be helpful to get a perspective of what's going on with commodity prices. Now, we call it food, and in the world of finance, they call them commodities, but it's basically food. So I'll play this clip for you.
Our next guest runs a hedge fund specializing in commodities investing. Dwight Anderson, the founder of Osprey Management, joins us now. Welcome to our show. It's great to have you on.
Scott, appreciate it. Thank you very much for having me here.
I mean, this is your wheelhouse. Truly is. Now's your moment. How are you taking advantage of it?
Well, both taking advantage, but also worried about it, Scott. Coming into this year, we were already worried about food pricing and agricultural prices. We had very tight balance sheets, and we needed to make a really good crop down in South America because our winter is their growing season. And unfortunately, even before the events in Ukraine, you'd had bad weather, so we had lost 15 million tons of the expected production we had for crops down there. And now with Ukraine, we're looking at potentially not just food price inflation continuing. We're already at 40-year highs in terms of those prices, but with a stocks to use ratio at 20-year lows outside of China, if the Ukrainian farmers don't get on their tractors, that's 100 million tons of food that's not going to be grown. So we're not just concerned about food inflation and prices continuing, we're actually worried about food availability and shortages, especially in the developing world, as this year progresses.
Surely, and rightfully so.
I want to go over to the market a little bit and look at, and this affects it affects everything, really. The stock market, bond market, recession, everything is tied to this. This is the yield, the change in the yield of the 5-year government bond. People are watching this. So you can see just in the past 6 months or so, the rapid rise in the yield. Well, think about this. You know that the yield moves in an opposite direction from the bond price or the price of the bond fund. So if we flipped this around, you would get a sense for the degree of rapid decline in bond prices and bond fund prices. You may ask, why does that matter? I'll explain. If you are an older person, or you're in retirement, or you're approaching retirement, or you're just an average investor, or you're in target date funds in a 401k plan or 403b plan, all of those contain bonds and bond funds, and sometimes a lot of bonds and bond funds. So think of, if it's you're an older person or you're approaching retirement, in retirement, the portion of your portfolio tied to bonds, and it may be significant, is going down at a rate similar to the degree that this is going up. In addition, equities are going down. So while equities are going down, bonds and bond funds are also going down. The protection that used to be there years and years ago, not in the last 40 years, but before the last 40 years, in the 35 years that preceded that, interest rates were rising and bond prices were coming down. But in the last 40 years, the opposite has been true. Interest rates and bond yields have been coming down, and bond prices, generally speaking, have been going up, providing an excellent, the best known protection for equity risk. But that's now gone. It's gone. Is it going to be gone forever? No, it's not. But it's gone for quite a while. And a lot of people are saying it won't go straight up. It will have corrections. But if you believe in rising interest rates, and as a method that the Fed is using to counter inflation, and that inflation is almost out of control, they're going to raise interest rates as fast as they have to. Bond yields are going to follow that, which means bond prices are coming down. And it spells trouble for traditional financial advisors and traditional investment portfolios. There's a spread between the 30-year bond and the 5-year bond, just like there's a spread between the 10-year and the 2-year. This shows that that spread has flipped, and that now, all of a sudden, the 5-year compared to the 30-year, the 5-year bond is yielding a higher rate dividend rate than the 30-year. And in normal conditions, that is not the case. Normally, it's the 30-year has a higher yield, etc. That has disappeared and gone negative. That is a primary indicator for a coming recession. The Philadelphia Fed Manufacturing Index, you can see is the outlook is negative, and the expectation of new orders even more negative. Why is this? Probably because of the previous charts showing that interest rates are going up, bond prices are coming down, which foretells a coming recession. I want to jump into the US market. There are three primary indexes here, and you can see from the far right the year to date, the rate of return for the Dow Jones, which is DIA, is the ETF, is negative 6%. S&P 500, negative 10%. The NASDAQ 100, negative 18%. And the government bond, the long-term government bond, which is the ETF TLT, negative 19%. This is what was supposed to go the other direction and provide that cushion for stocks. And here it is participating in a big way right alongside of stocks with a decline of its own. NASDAQ 100, technology sector in the NASDAQ 100, which is most of the NASDAQ 100, negative 24%. And the ARK funds, the innovator funds from the ARK family of funds, is down 44%. ARK-K, which is their primary, their leading fund in that fund family. The major indexes, there are 4 of them in the US and there are 2 international. So we've talked about SPY, SPY for the S&P 500, Dow Jones, DIA, the QQQ, NASDAQ 100, and IWM for the Russell 2000. So that would be the 4 indexes, and then EEM for emerging markets and EFA for developed countries, foreign countries. On the right, the far right, you can see how these indexes are relative to their moving averages. When they are above their moving average, that is a positive sign and generally indicates bullish or positive conditions. When they are below their moving average, indicated by a red dot, that is negative or bearish conditions. So on my dashboard, all 6 are negative in all relative to all of those moving averages. So here we have 24 out of 24 are negative. Very bearish, very negative indicator. At some point, they will turn positive and move back above those. But for now, this is not an upward moving market. It is not trending upward. It doesn't look like it's going to trend upward for some time. But for now, the best of the worst is the Dow Jones, DIA. The worst of the worst is the NASDAQ 100, QQQ. When you break down the S&P 500 into its 11 sectors, these are the 11 sectors. So you can see the component parts of it. Some are positive, some are negative. They usually are not all negative. But there are 44 dots on the far right. There are 11 sectors and 4 moving averages, the 20, the 50, the 100, and 200-day moving averages. 2 of them, real estate and consumer staples, are above all four of those moving averages. So those are of the component parts, those are positive components of the S&P, but they're way overshadowed by those that are below the moving averages. So you can see real estate and consumer staples at the top, and then they go down from there, basic materials, energy, healthcare, etc. So these are some charts to show you the direction of the market. This is a 12-month chart showing the weekly changes and over the past year. So you can see during the past 4.5 months that the general direction of the S&P 500 is down, and it is below its 20-period moving average, and it is moving, generally speaking, in a downward direction. At some point, it'll turn around and go back up, but at this point, it is negative. When you look at the component parts of the S&P 500, you find there are two general categories of stocks. These are all large companies, the 500 largest companies in on the stock exchange, basically. So there are growth companies and there are value companies. Growth companies are companies that focus primarily on sales and less on profit, and value companies focus more on profitability and less on sales. So this is a 12-month chart comparing the two. So it's a relative chart, the relative performance. The growth is the numerator and value is the denominator, represented by SPYG and SPYV. So for the last 5.5 months or so, the direction is down, and what that means is that the growth part of the S&P 500 index is more negative than the value component of the S&P 500. They may both be negative, but growth is even more negative. So you would say from this chart, value type stocks are more in favor than growth type stocks, which is not surprising in a, generally speaking, downward environment. You compare the S&P 500 itself, all of the S&P 500 represented by SPY, to the small cap index, the Russell 2000, represented by the ETF IWM. You can see that they are that the relative to one another, that the small cap IWM is weaker than the S&P 500. I've already shown you how weak the S&P 500 is. Now, the Russell 2000 small companies are even weaker than that. So, among the weakest among the weak is IWM, and of course, we know the Nasdaq 100 is also weak. But this has been weak for relative to the S&P 500 for about a year. The long-term government bond, we've talked quite a bit about bonds, and the long-term government bond, the ETF, is TLT. And the 24-month weekly chart shows that it is definitely in a downward direction and definitely is below its 20-day moving average. And, or excuse me, 20-period moving average. And at some point it'll go back above it, but it is not in a trending mode. Why? Remember, interest rates are rising, which means bonds and bond funds and bond ETFs need to decline because interest rates tie into yields, which are inverse to the price of the bond itself, which makes up a good portion of a lot of investment portfolios. The Vanguard has an extended duration government long bond with the ETF EDV. And this is the direction of EDV since November 25th, 2021, continuing in a long-term decline, down 27% since 11/25/21. I'm going to jump over to gold. gold and silver, precious metals. This is a 24-month chart, so I'm showing you 24-month period. It's not relative to anything. It's an absolute chart showing the direction of gold represented by GLD. And you can see that it has gone up and down a lot, but the general direction over that 24-month period is up, and it is above its 20-period moving average. We look over to silver, same thing. Silver is just dropped slightly below the 20-period moving average, but the general direction is up over that period of time. When I compare on a relative performance basis, a weekly chart over 24 months, you can see for about 10 months that silver outperformed gold. But for the last 14 months or so, gold has outperformed silver. They both have gone up, but what this shows is that during the first part of this period, silver outperformed gold, and for the second part of this period, gold has actually outperformed silver. So this is a chart showing what Chairman Powell is attempting to do, is to do a soft landing. Well, you can tell from this, it doesn't look like that's very likely, as I explained earlier. But if I were him, I would be thinking, I would have something like this cartoon in my head. When I woke up in the morning, I would think, this is what I've been dreaming about. This is not very good. There is no way that has ever happened in the past where we have these conditions, rapidly rising interest rates, almost out of control inflation, and very tight employment market, all setting the stage for probably a crash landing. And what that means is recession. That has, in previous recessions, has meant a serious declining stock market. In this case, we go back to pre-1980, 81. This case, it means with the environment we're now facing, falling bond prices, so falling stock and bond prices, which is horrible for traditional portfolios, and probably a declining real estate market. Now, real estate throughout the US, in most areas, and certainly in the cities and in high demand areas, real estate is very hot and is in high demand. And prices are escalating, multiple offers, bidding up of properties. We hear those stories. That is likely to change. If we're in a recession, it has never meant rising real estate prices in the past. I doubt that it will in the future. Jobs, anyone today who wants a job can get it in most areas. So that is going to change if it's like previous recessions. Business will slow down, people will get laid off, and jobs will become more scarce. And I don't know the degree that this is going to happen, because I think this time is like no other in history. I think this is closest to the early 70s, the 73, 74 crash, and where the stock market went down about 50%. And there were, high energy prices, high inflation, high interest rate, and so forth. So that was a very similar. There were many similarities. We did not start at interest rates and bond yields that were as low as these, but it definitely has a lot of characteristics that are similar. So with that, I thank you for watching. If you have questions or comments, leave them in the comment section below. As I said, there are links to the sources of my information, outside sources. And if you like this, hit the like button and subscribe to the channel if you would, please. Thank you very much.